OECD has come up with this global minimum corporate income tax. What is the idea? That idea is minimum 15% these corporates have to pay to the domestic countries where they are operating.
Subscribe and press the bell icon so you never miss an update from PrepLadder.
All about that one. Now if we talk about the next news, that is related to the OECD, and that is global minimum corporate income tax. So these proposals have been made by the OECD where the multinational enterprises, where actually they are indulged into some of the activities, means if we talk about BEPS system, that is base erosion and profit shifting system. Under this BEPS, remember these are the guidelines of again OECD. Now multinational companies, if they are operating in India, let's say, so this is the company A which is operating in India. Now what they will do in order to avoid the taxes, they will shift their profit to the country which are tax haven. Let's say this is Mauritius. So in this way they are going to shift their profits, and how we are going to prevent them with using these BEPS standards. Okay, so this is the guideline, that is base erosion and profit system. Again, this was the guideline of OECD only. OECD has come up with this global minimum corporate income tax. What is the idea? That idea is minimum 15% these corporates have to pay to the domestic countries where they are operating. This is going to be the minimum tax amount, 15%. Remember this one. How we are going to ensure them? This is we'll discuss. So this is global minimum corporate income tax. There are two aims. The first is they are using the loopholes, means these companies are shifting their profits. So this is the first thing, we are going to prevent them from this shifting game. Okay, the second thing is will ensure whether they are physically available into that country or not, but their services are there. Again, they will have to pay the taxes even if their services are there and they are not physically present over that area. So these two are the aim of this particular guideline. So under this global minimum corporate tax, we are coming up with this one, that is global anti-base erosion. Remember this GloBE and BEPS we have already discussed. If we talk about OECD countries, so OECD organization, so that came into 1961 and the headquarters is in Paris. Remember, India is not the member. There are total 38 members as of now. India is a kind of partner country, but not the full-time country under this OECD. So OECD's idea of BEPS was already there. Now we have the GloBE provision. So GloBE provision are also from the OECD. So how we are going to ensure? So there are two pillars, pillar 1 and pillar 2. The first pillar, these guidelines are going to empower the countries to tax these companies where they are earning the revenue. Means no matter if that company is based in USA but it is operating in India, the physical presence is in the America but the services are there in the India. Now India will be empowered to put taxes on this particular company. This is one idea. Now in this way the excess profit would be counted of this company, and if it is beyond 10% of their total revenue, then it would be termed as an excess profit, and that will be charged 25% as a tax. Okay, let's say a company is getting 100 rupees, and if it is we take more than 10 rupees, means 10% is the 10 rupee. So beyond that 10 rupee, that is 90 rupees. So on this 90 rupees, India can levy a tax of 25%. This is the first pillar. The second pillar is if these companies are not providing the minimum tax which is provided here, let's say company A is earning 100 rupees in India, and according to the Indian tax norms, it has to provide 15% of the revenue, means 15 rupees it has to pay, or it was supposed to pay, but because of some conditions, if they are paying only 10 rupees, now this 5 rupees balance, means minimum 15% is the tax now. So this 5 rupees balance would be provided to the India from the home country. Means if this entity was working in USA, now USA would provide the balanced 5 rupees to the India in order to make this as a 15% tax. That is the minimum tax, and that is known as top up. So with this top-up tax, the domestic country of that country would provide the amount which is less than the 15% amount in case of the India. Okay, so this is the idea. So with these two pillars, we are going to ensure minimum 15% of the tax should be given by these MNC companies to the companies, to the countries where they are operating.